Hi, everyone. Welcome. So excited to have you all for the opening panel. For everyone who's watching, we are beginning our first panel of the day, starting strong with institutional trends in DeFi in 2026. So for this, we have Ben Schiller, who's moderating this panel. It was previously managing editor of CoinDesk and is currently a senior advisor to Miden. Joining us, we also have Chunda McCain, who is co-founder at Paxos Labs, Giovanni Everduin, Gio, who is Chief Innovation and Strategy Officer at CBIx, and Vivek Raman, who is founder of Etherealize. Welcome, guys. Super honored and excited to have you all. And I'm going to remove myself from stage. I am on the chat if you need anything, but please go for it.
Great. Hi, Michelle. I hope you can hear me, everybody. I'm Ben Schiller. I'm with Miden, senior advisor, and for about 25 years I was with a journalist for the last 6 years at CoinDesk as a managing editor. So great to be here with you all, and I think we've all kind of seen the rise of DeFi in the last few years, going from being a relatively niche sort of activity to being something much more institutionalized, much more regulated, and much more accepted these days, especially with this current US administration. So looking forward to talking with all of you. Would you like to just introduce yourselves and just situate the audience here? Gio, do you want to start us off? Who are you and what do you do?
Yeah, so my name is Gio. I'm Dutch. I work in Dubai. This background is actually from Dubai Desert. I'm the Chief Strategy Innovation Officer for a bank, which really means that I'm pushing the boulder uphill, trying to get the bank to innovate. I'm also the co-founder of CBIx, which we just launched yesterday, which is a separate entity that kind of is an innovation lab in our corporate VC and is where we can do a lot of our DeFi experimentation.
Excellent. Chunda, you want to go next?
Yeah, appreciate you, Ben. My name is Chunda. I'm one of the co-founders of Paxos Labs, which is the newest innovation out of the Paxos group. We focus primarily on what we call providing next touch capabilities for enterprises looking to implement and integrate crypto capabilities on platform and further users or enterprise clients. So specifically, that's focused on spend, understanding how you can spend and orchestrate and off-ramp digital assets, earn, generating yield on primarily stablecoins, and then enterprise borrow-lend interfaces, collateralizing capital on book, on enterprise balance sheets, as well as with digital assets, and then performing different financial actions with them.
Excellent. Vivek, I see you got a piano behind you. You're going to be playing something for us today?
One day it'll be real. Right now we're on the
Okay.
Thanks for having me and great to see you. So I'm actually not a crypto native. So I spent 11 years on Wall Street. I was at Morgan Stanley, UBS, Deutsche Bank, Nomura, and traded a bunch of esoteric fixed income credit products, all of which were running the US economy, but they settled and traded like people do in the Stone Age with phones and faxes and very, very backwards technology for a very advanced capital markets regime. So I left after 11 years. And when I found Ethereum in 2020, I saw it not as like some utopian technology, but actually as the settlement layer for where financial assets could be tokenized and trade and settle and just upgrade existing systems. So that's what I've been working on for the last 4 years, institutional adoption and getting more and more institutional players, banks, asset managers to use the Ethereum blockchain and the different facets of it. It really started for 3 years. I got rejected from a lot of meetings because the US especially was not ready for adoption. All of that switched last year when you had titans like Larry Fink say that the whole world's going to be tokenized, and you saw the ETFs get approved and regulatory clarity started. So that's when we formalized Etherealize. We got some backing from the EF and Vitalik to get started, built an independent company called Etherealize to go actually onboard institutional assets and players and infrastructure on public blockchain rails. If there's ever a time that you'll see max adoption, max willingness to do it, it's right now. So we've been sprinting and excited, very, very inspired by the progress that we've been seeing over the last year.
Well, that's really interesting. And maybe, Vivek, you could start us off here because you've seen the kind of the switch in attitudes and kind of culture around, blockchain technology on Wall Street, and Etherealize is very much a kind of trying to take Ethereum to Wall Street. So just talk a bit more about that. I mean, how is the conversation you're typically having with somebody on Wall Street changed from 4 years ago when you started to now? I mean, just give us a sense of the day and night there.
Yeah, it's been a lot of those. So it's getting to this position where now finally you're seeing the rush of adoption. I mean, just like when ChatGPT came out and then every institution had to do an AI strategy internally, we're at that moment where every institution has to do a blockchain strategy, and not just any blockchain strategy, but a public blockchain strategy. So, I mean, it's not like blockchains are new. Wall Street people are very smart, and they know that there are tools out there that can help their processes. We've seen 10 years of private internal blockchains being built, consortium blockchains. I mean, proof of concepts that never really unleash the real potential of blockchains because they're private and internal. Once you unlock the public blockchain moment and put assets and operations onto public blockchains, commerce becomes better. And I think that Wall Street finally realizes that the thing they were waiting for was for regulatory clarity, especially in the US. And once the US said, let's put stablecoins into law and let's start to even like codify crypto by a market structure bill into law, it's now de-risked. So like while we've seen the tech sector and blockchain sector before let's move fast and break things and try and innovate outside of the regulatory perimeter. That's not how the financial system works. Now that we actually can, in a risk averse, in a methodical way, onboard assets, onboard institutions, it's been a flood of interest, and people want to do a lot of different things. They want to tokenize their assets. They want to build their own custom blockchains, but on public blockchains. So the Ethereum Layer 2 model is really being validated over this past year. And the third thing is to start to use DeFi, see how their operations and everything can be more automated. So yeah, I feel like the moment's finally here, and I'm pretty excited about it.
Excellent. Gio, so how does it look from your part of the world? You're not in the US, but do you think the US and the change of environment here has affected you?
I mean, it has affected everyone for many different reasons that I don't think we're going to get into right now. But I think anything that happens.
I mean, in terms of DeFi and crypto.
I know what you mean. Well, it hasn't really. I think one of the things that's really interesting about this part of the world is that they've been pushing forward fairly aggressively. And so I think what we had over the last couple of years in the previous administration on your side, we got a lot of US companies coming out here, setting up here, right? Because the regulatory framework was just a little bit more clear, articulated, it was welcoming. And so we've been pushing forward independently. So I'd say, the Genius Act didn't really change anything for us. If anything, it's quite the opposite. I think now that the administration is a lot more supportive of crypto, we're seeing a lot of talent like reconsidering if they want to move back to the US, right? So for us, you could arguably say it had a little bit of an adverse effect, but no, it's here. We've been pushing a lot on the tokenization front. A couple of interesting initial use cases done on the real estate tokenization. One of my biggest shareholders in our bank is one of the biggest banks in the region, bank out of Qatar. And we've kind of been helping them set up the first tokenized money market fund by a bank here in the region, right? And that was a big thing. I mean, you guys will appreciate it. Tokenized money market fund is not particularly sexy, but for a bank to do this, you have no idea the hell we had to get through just to get everyone aligned to that. And so that by itself, I think, was a very big step. People understand tokenization. They understand that, you can effectively tokenize capital markets everywhere. And I always tell this story, there's this scene in The Big Short where Mark Baum goes to this restaurant, right, to meet Byron Mann, and he's kind of looking at him and telling him how he's going to wrap all these things in completely unregulated fashion. I feel like that's the look that I see on a lot of bankers' faces these days when they think about DeFi. It's like, well, what? I could take a stable and wrap it and what? And so there's a lot of interest. But what I see, at least here, is that a lot of the use cases are still fairly basic, right? People are still trying to wrap their head around it, trying to make sure that the regulator is okay. We can't, unfortunately, afford to break a lot of eggs to make an omelet. So we just go tiny little bit by tiny little bit.
Well, could you just fill in the details there a little bit? I mean, what would you consider to be basic, and what would you consider to be more advanced in terms of?
I mean, DeFi? Look, I think when you start talking about, so when I have, DeFi companies come and pitch to our bank or other banks, right? The moment they start talking about yield generating vaults, or they start talking about liquid staking, I think you lose almost every TradFi guy in the room immediately, right? That's a lot more advanced. So what people get is like tokenizing deposits. It's very straightforward. I get what that is, right? You can sell that. One project we're working on right now is tokenizing music IP. Again, very simple. It's an asset class. People understand it, tokenize it, give it more liquidity. Like these are like, I feel like a lot more native to traditional finance. These kind of things people are willing to do. Cross-border payments, right? Using stables, JP Morgan's Onyx network, we're doing something with that. People are understanding these kind of things. But I think when you really talk about the more degen side of DeFi, it still kind of frightens people. And I think a lot of people just don't necessarily understand it. I also think there's a language mismatch, but we can get into that later.
Interesting. Chunda, how does it look for you? Do you see a mismatch between degens and Wall Street culture? And when you talk to Wall Street, are they, when I say Wall Street, I mean mainstream finance. Are you talking traditional use cases for blockchains, or are you talking more sort of degen stuff?
You're muted.
Appreciate it. Yeah, I mean, it's all relatively kosher. So the way that it's kind of interesting. So the origin story for why we kind of created the new product line with labs out of Paxos is that we were focused on kind of understanding where the next step of our client capabilities needed to be, right? And what we realized was after the administration shift in America, many of our clients and many of our client inbound, so we're talking Fortune 50, Fortune 100 companies coming to us for solutions. Traditionally, they would come to us for some of the first step capabilities that we already had. So stablecoin issuance, crypto brokerage, and some of the orchestration capabilities. But soon after, we were seeing RFPs that had requests for things that, I think in our positions 4 or 5 years ago, we wouldn't even imagine. So for example, a large enterprise came to us relatively recently for a stablecoin issuance product. And within the same RFP was asking the question, how can we also do digital asset backed lending and borrowing? Leveraging the stablecoin as one of the core sources of lending liquidity. And for us, that was a very kind of abrupt wake-up call where we realized that faster than I think anyone in the industry thinks, a lot of these larger enterprises kind of notice what we like to call the quote-unquote common sense use cases of DeFi, and want those capabilities and want to scale those capabilities as soon as they can within reason, right? Now, you'll still have this gradient of a sense of comfortability when it comes to these enterprises, right? I think how we think about quote unquote DeFi or like the D in DeFi, it's not necessarily how most enterprises think of leveraging DeFi. I think they like the concept of on-chain finance, but I think the concept of decentralized finance is a little bit kind of outside of that scope. Now, you'll find some like Coinbases that will be very comfortable with these kinds of ideas. But I would say the vast majority of the enterprise market are really looking to leverage some of the efficiency and composability around on-chain finance, but really require enterprise scale gating and compliance requirements around these types of implementations.
Gio, you were nodding your head or saying yes to that. I mean, do you think that the D in DeFi is a bit of a misnomer, that we're really talking about on-chain finance here and not sort of decentralized finance?
We talk about CeFi 100%. Like every time, like this is very different. I feel like this is more on for me, this is on the DeFi side, but I'm on a lot of these like closed door panels and roundtables with the TradFi people. And the only thing we talk about is, centralized permissions, right? And so this notion, so it's kind of like, and it's funny because the other day we were talking and we're like, well, this is kind of a long shot from where the cypherpunk movement was kind of pushing this whole thing, right? But it is, because at the end of the day, if you think about what we do, when I say we, TradFi in the most general sense of the world, being heavily regulated, we need and want control. So this idea of having a public chain decentralized is very scary for most people. And outside of the fact that I think most people who are in the control functions, risk, compliance, don't necessarily understand what that actually means, right? So one of the things that helped us a lot in our bank, I'm very blessed that our head of compliance is very curious, right? Is very curious about learning how this stuff worked. And so we had Chainalysis come in, and they kind of did a run through for him in terms of how on-chain forensics works. And after that, he's like, wow, this is amazing, right? Like, I wish it would be this easy for all the other stuff. And so, but that's a lack of understanding that people initially have. And if you have a lack of understanding and you're heavily regulated and the penalties for potentially being non-compliant are very high, your incentive to try something new are fairly low.
Vivek, maybe you could chime in on that. I mean, Ethereum is known for its fealty to decentralization. We get a message every week from Vitalik saying we really believe in decentralization. How do you kind of square that circle with the clients that you're talking to if apparently they don't care about decentralization and yet you want them to come to Ethereum?
Yeah, it's. I think that we're saying the same thing just in a different progression. So I think it's a very positive sum game. So I mean, what we want to do first is have blockchains be the rails for the world's financial system. So once you bring enough assets on chain, a large portion of them will be permissioned by necessity, but also a large portion of them can actually go cross borders, can cross jurisdiction. You can package up yield differently. Like, I just think about my journey into Ethereum in the DeFi world, and it started with me using Uniswap for the first time, and then eventually went to using all these like degen, tranche, perps protocols. It's kind of the same thing for the banks and financial institutions. Like, first, let's have them use blockchain infrastructure. I like to call DeFi programmatic finance. It's like I said, it's on-chain finance, it's programmatic, it's automated finance. It actually is a tool to make processes better, but it's not like if there's money and potential and opportunity, it's not like banks won't start doing structured products on chain. It's not like we won't take yield and start tranching it. I mean, it actually allows you to do a lot of the financial innovation that happened, but that happened opaquely in 2008. Now you can do that more transparently and with more checks in place. So I actually see this as being a more robust way to do the financial sector. It's just going to take some time. So first, let's bring a lot of assets on. Let's bring yield. Let's bring tokenized products on. Let's have institutions anchor their operations on Ethereum and on layer 2s. And then the magic of DeFi can happen. You can have low risk finance, which Alec writes about. You can have riskier finance with certain parts of RWAs, and that can happen on layer 2s, for example. But all of it's possible. Like, all of it will happen. It's just a matter of when.
So, I mean, that's a really interesting thought experiment there. I mean, you mentioned the Big Short earlier and the previous financial crisis in 2007, 2008. I mean, do we think that that financial crisis wouldn't have happened if those financial transactions had been on chain? If we could check into those, into what was going on? Was it the lack of transparency in those systems that allowed that catastrophe to happen?
I mean, my take is it's just human ingenuity. I think whatever you do on chain, off chain, we will find ways to extract value from the system. I mean, it's as simple as that. And I arguably say one of the things that makes a lot of the bankers I know fairly uncomfortable is because every time you talk about crypto, they'll throw like one of these, like FTX, right, a mantra, or there's always something. And the problem with that is, and we don't need to get into that now, but there's obviously reasons for that why you can't really compare what happened in these situations to a systemic failure that happened, back during the days of the Big Short. But it is just because it's new, the scrutiny is a lot higher, and the bar, right, the quality bar, the expected quality bar, is significantly bigger. And so for people, crypto still, I speak to people who still believe that it's just a scam, right? It's just a playground for a lot of scammers. And all of us here know that that's not true, or at least it's not more than on the traditional finance system, but it's the perception, right? And the proportion of cases versus, the maturity of the ecosystem just makes it amplified to most people's minds. On top of that, people tend to report all the negative stuff, right? Because that's juicy. And so for me, that's a risk. That's a problem that I'm facing. People feel crypto is just high risk because in their minds, Mt. Gox, FTX, whatever other situation that happened.
I think there's also something to be said that in every one of those situations, it usually was a centralized actor. You think about, let's extend it to Celsius Voyager as well. These were all opaque systems. In fact, I don't think outside of UST, you could really count any one of these instances as an on-chain failure. And so it's actually kind of interesting. It's a little bit of a survivorship bias situation, but it's a bit of kind of an interesting call out that in every type of crypto failure to date, we have actually strayed away from the decentralization ethos and the transparency ethos that was at the core of it. And I think moving forward, that's something where I think not necessarily on the centralization side, but definitely on the transparency side, we can focus on beating that drum and say, hey, in this FTX example, in the Voyager Celsius example, if we actually had all these assets on chain, the result might have been different, but we did not, because we were trying to kind of fit a square peg into a round hole to kind of appease the pre-existing kind of consumers in the market at that time. And so it's a really good, in my head, like forcing function to actually stray more towards what we think is like the ideal future for DeFi.
Yeah, I want to jump in with that as well, because decentralization, how we pitch decentralization isn't, again, some utopian vision of like, what decentralization actually means to everyone is security. And so who cares most about security and lack of counterparty risk? Like Ethereum's the only system that literally no one owns. It's a global neutral infrastructure. And so that makes it so it has the least amount of inbuilt counterparty risk, which means that large institutions are more likely to use neutral infrastructure than infrastructure built by someone or controlled by a few validators or where there are single points of failure. So if you look at it, actually, I've actually, like, the days of people pointing to Mt. Gox and FTX, they're coming to an end. And I think TradFi knows, and they see all the stress tests crypto has gone through from 2020 crash to even the October 10th crash. Nothing in DeFi broke. Like Aave didn't break, Maker didn't break, Uniswap didn't break. In fact, they were not only resilient, but they functioned despite massive stress. If you think about where institutions will transact with billions or trillions of dollars, it's going to be on decentralized, which means secure protocols where there's no counterparty. And so, like, as they're starting to shift their mindset to, maybe we should do our treasury repo on chain. Maybe we should do our borrow lend activities on chain. Maybe, like, the best customers of decentralization, ironically, are the banks. The people that care less about decentralization because they just want something fast and cheap are consumers, and they're the ones that end up getting hurt. But as crypto becomes institutionalized, I actually think the values of decentralization and a programmatic economy go up a lot. So I actually think we're going to see really good adoption very, very quickly.
Well, that's really, really interesting. So it's kind of a crossover of reasons to have decentralization. It might not be the original reason why we had decentralization, but it's a good new reason to have it. Okay, so maybe Chunda, you could take this one. Just interested in the kind of timeline for adoption and the types of products that we're going to see rolled out by TradFi institutions as they adopt blockchain. Just give us a sense of the types of product we're going to see going forward in the next couple of years.
Yeah, it's a good question. I think before I answer that in particular, I think something that's interesting that we've noticed that's been a shift in this newer age of, let's say, enterprise adoption, newer age dating November 24 onward, is traditionally we saw a pretty linear progression for enterprises when it came to adoption. And you can kind of see it reflected in a lot of the business lines that we have at the Paxos side, where, our business lines are trifold. First, it's, helping enterprises accept crypto on platform, buy, hold, and sell it. And then it became, all right, let's also provide the capabilities to accept stable coins. And then it became, let's provide the capabilities to issue stable coins. And generally, most enterprises started at one point, usually on the far left there, and went forward, right? And what we're seeing now is a bit of a different situation for enterprises, where sometimes they'll jump in on a different part of that journey, right? I've talked to banks where, they come to me and they're like, hey, we want to bring our lending desk on chain, and they have none of the other capabilities, right? Or they said, hey, like, we're interested, they'll go off that scale and they'll say, hey, we're interested in asset or securities tokenization, and then embedding this onto yield products, and they don't even have stablecoin acceptance, and they don't hold anything on chain or any digital asset on their platform, right? And so I think as we move forward into the future, the kind of starting point for a lot of enterprises won't be as linear or as simple as it has been historically. But in terms of the places that we will see a lot of adoption, I think it's kind of fixed in like one of those three capabilities, as well as four, which I'll outline. One of which is like spend. How do I figure out how to kind of connect digital assets, both on the stablecoin and traditional kind of like digital asset major side, to the payment system and to kind of the global remittance systems that exist.
Sorry, could you just explain what you mean there? I don't quite understand.
Yeah. So, for example, a lot of businesses and enterprises that accept stablecoins, as well as like consumers, also need to plug into the legacy rails to spend those digital assets, right? So we're seeing a massive growth in kind of two different pieces, like the orchestration side of the business, and then the kind of card issuance and like remittance side, payment side of the business, that is kind of coinciding with that growth. And there's a lot of demand from different enterprises kind of moving forward in this kind of vertical. I mean, we saw the Western Union announcement a few days ago, right? So that's one piece of it. The next piece of it is kind of accessing different forms of on-chain finance. I see that in primarily two different verticals. One is tapping into yield. And that's usually, most people today are comfortable with over-collateralized lending or some form of RWA exposure, both of which, because they're concepts that are pretty simple to understand and also are reflected pretty prolifically in the traditional finance environment today, right? Because really all you're doing is selling a concept that is pretty much ubiquitous in traditional finance and or already pre-existing traditional finance vehicles. The third one is actually settling some financial activity on-chain, specifically borrow, lend, and swaps. So leveraging on-chain venues to have faster finality and less counterparty risk on trading assets, as well as on collateralizing and borrowing and lending against assets. And I think really what you're going to see is the concentration of most, I'd say like you're going to get a Pareto distribution of most enterprises and institutions kind of sitting somewhere within that range of using DeFi. You might have some people kind of step out and do more exotic things, but I think realistically, everyone's going to start somewhere on that spectrum.
Great. Thank you. Gio, so you discussed tokenizing the money market fund, and you discussed tokenizing some real estate. Where do you see those two projects going in the future? Are you going to be doing more buildings, more money market funds?
God, I hope not. No, look, the tokenized money market fund is an interesting one, and I think there's a couple of things behind it that make it very successful. For starters, most of the big ones currently are all US centered, and we found there's a significant demand, particularly in Asia, for having something that's operated from the Middle East. I think the fund will grow and grow. They're starting fairly modest, but I think there's a lot of potential there. More than the fund itself, I think what's interesting is now that we're doing that, you can start thinking about using those tokens as collateral, right? Chunda and Vivek both spoke about that. And that's a great entry point, because I think using virtual assets or digital assets as collateral is a very obvious thing to do for us as banks. But it's been a struggle a little bit. And that kind of leads me into tokenization of real estate. I'm not particularly very excited about tokenization of real estate. I think there's other things that make a lot more sense if I had to do it, to tokenize.
Yeah.
The problem I see with real estate, and particularly with these small tests, is that, yeah, you plant the flag, right? We tokenized an apartment or whatever. But the issue for me is tokenizing either a liquid asset and making it less liquid, or tokenizing an illiquid asset and making it fractionally more illiquid doesn't seem to be a solution to a problem. Right? And that's what I've seen. Now, I'll give you an example. Let's say that I want to give a micro mortgage for some of these tokenized real estate pieces, right? That could be an interesting business. But the first question I'll get from my credit team is, well, how easy is it to sell these if someone defaults, right? Is there a secondary market with liquidity? The answer is no. Right? And I feel like people kind of jump the gun, like, all right, let's tokenize something. But then very often it's like, well, where's the secondary market? Where's the liquidity going to come from? And if you don't solve for those things, right, which you have in DeFi naturally embedded, but if you don't solve for those primitives, then it kind of just becomes a gimmick and it doesn't really go anywhere.
Yeah, I mean, we've seen a lot of press releases over the last 7-8 years about various entities tokenizing real estate. I mean, it sounds like a sexy idea, but you bring up the practical challenges of it. Vivek, just give us a sense of the next couple of years. What exciting things have we got to look forward to?
I think we're at the cusp of the real adoption moment. So I think we're going to see, I mean, it's not going to be like small proof of concepts anymore. I think we're going to see trillions of dollars of real world assets and every permutation, like real estate. I actually think a lot of real estate does belong on chain. A lot of it that you said, Gio, doesn't. So like, I think we're going to see experimentation across all of it, and where it's kind of a flood of opportunity to ranging from fully permissioned to more permissionless, ranging across geographies, ranging across institutions. Our main focus is to make sure that to maximize the probabilities of the possibilities of public blockchains, you want everything in one economic zone. And that's why we come to Ethereum and say, okay, well, if everything's on layer 2s, layer 1s, then interoperability and integration across the app layer and similar tooling and similar standards, then that ends up creating network effects. So our goal is to bring as many different institutions, layer 2s, assets into this economy, and then see what happens. And the magic of, I think we're going to boomerang back to the OG DeFi once everything's on chain and people actually start innovating and making cool things. And that's going to unlock the financial sector. So really
isn't it a bit of a contradiction to say we want decentralization of everything and then say everything needs to be on Ethereum?
Well, I think Ethereum is the most decentralized platform globally, then, and definitely more than other layer 1s. I don't think it's a contradiction at all. I think it's actually, it's like saying we want all the information on the internet, not on 15 different intranets. That's kind of the exact same thing we're trying to do, just for money and assets.
All right, fair enough. I won't argue with you about that. All right, well, thank you very much, all of you, for doing this. It's been great to have you, Gio, Chunda, Vivek, and we'll do it again sometime. Thank you.
Appreciate you having us on.
Thanks.